Let's talk global with Kim Do, head of Asian Multi-Asset Group with Bearing Asset Management. Kim, good afternoon. This is Nikunj Dalmia from the Mumbai studio. Thank you for joining us. At Bearing Asset Management, what is your take on the region, and what do you like within the regional market when it comes to financial as a category?
Our preferences for banks in the region are mostly in the ASEAN nations, actually. So that includes a number of banks in Indonesia, in Thailand, and in the Northern Asian markets quite selectively. I think that some Chinese banks are also very interesting to look at, but one has to be selective.
Afternoon, Kim. If you could tell us how you're viewing the U.S. economy, do you think it could get re-rated or upgraded as an investment decision, given the signs of recovery that we are getting from the U.S. economic data?
In fact, if one looks at the U.S. stock market, it has already been re-rated since about 12 months ago. I think that if you look at the performances of the S&P 500 against the rest of the world, it has done very well against the rest of the world. So the re-rating has already taken place. So the question is whether it will continue to be re-rated. And we believe that, in fact, the chance of that happening is reasonably good, because earnings per share growth in the U.S. has tended to surprise on the upside. And also economic data in the U.S. by and large over the last 6 months also surprised on the upside. Although in the short term, if you look at the Citi Economic Surprises Index in the U.S., it actually has turned down. So I think that maybe expectations about the U.S. economy has been elevated to such a point that a number of economic data points which came out over the past few weeks actually surprised, or not surprised massively on the downside, but disappointed the high expectations in the market. But overall, we still like the U.S. stock market as a destination within the equity market.
Kim, what are your thoughts on Europe? We've got outcome of French elections soon, then you've got elections in Greece. Where do you see Europe by the end of the year?
Europe is still a difficult area to manage from an equity from a multi-asset viewpoint or from an equity investor's viewpoint. And the reason is obviously back to the issues which we have lived with and had to face and had to contend with in the long term, and that is the debt and the banking issues. And I think that the ECB has done a great job in terms of implementing a number of measures to try to put some kind of a safety blanket in the banking sector. But the problem with the debt, with the enormous debt burden in a number of economies in Europe, hasn't gone away. So I think that to make a prediction of where we are going to in Europe is quite difficult. I would say that overall our strategy as far as Europe is concerned is to remain underweight.
Okay, that's your view on the European region, but are you increasing your exposure to safe haven assets in gold, the dollar, the US treasuries, or emerging market debt? And how are you managing risk in your portfolio in the current state of the market?
From the beginning of this year, we actually have increased our exposure to risky assets. So we actually have been buying more high-yield corporate bonds. We've been buying more equities. Currently, we are just staying with those positions. We have some profits, obviously, in our portfolio, which are perhaps tempting to I mean, those profits are quite tempting, and maybe we will want to lock in some profits at some stage. But at the moment, our valuation, our reading on liquidity, and our reading on the economic indicators suggest to us that we want to stay with these long positions. As far as gold is concerned, we have actually, if anything, reduced the gold position to some extent. Emerging market debt, we're staying with that. US bonds and OECD bonds, if anything, we have used that as a source of funding when we bought more risky assets at the beginning of this year.
Finally, Kim, what are your thoughts on global liquidity, and at the current juncture, do you think EM equities are looking fairly priced and fairly stretched?
Funds flows, if anything, have been favoring debt or yield. Government bond funds, high yield corporate bonds, emerging market debt. That's where most of the funds flows have been going towards. As far as equities are concerned, it has been a bit mixed year to date. We hope that investors will feel a little bit more positive about the world economy and will go back into the equity market at some stage. But that is at the moment more of an expectation than a reality.